Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh dan salam sejahtera. Pada sidang akhbar ini, Bank Negara Malaysia akan menyampaikan taklimat mengenai prestasi pertumbuhan ekonomi negara pada suku tahun ketiga 2018. Taklimat ini juga merangkumi perkembangan monetary dan kewangan di Malaysia, isu khas serta butiran mengenai inisiatif dasar Bank Negara Malaysia. Taklimat ini turut dihadiri oleh Ketua Perangkawan Malaysia, Datuk Seri Dr. Muhammad Uzair Mahidin, dan Jabatan Perangkaan Malaysia adalah agensi rasmi yang mengumpul dan menerbit statistik KDNK negara. Most economic indicators continue to suggest that the global economy is expanding, although with signs of moderating momentum. Near-term and forward-looking global indicators such as the monthly Purchasing Managers Index or PMI and export volumes have recorded a much more moderate expansion in recent months. Many countries recorded slower growth in the third quarter. The acceleration in the US and UK GDP growth stands in contrast to the Euro area. The strength of the US economy was driven by further improvements in the labour market, with additional lift from fiscal policy support, while UK growth was underpinned by private consumption. Economic growth in the Euro area, however, moderated, reflecting mainly slower investment activity. Domestic activity in regional economies such as the Philippines and Indonesia benefited from ongoing policy support and higher infrastructure spending. Global trade moderated, in line with normalizing global demand amid heightened global trade tensions. Despite these global headwinds, the Malaysian economy registered firm growth in the third quarter, with growth being driven by three key developments. Firstly, the more favorable household spending, especially in July and August. This followed from the zeroization of the goods and services tax, positive sentiments and supportive labour market conditions. Private consumption registered faster growth of 9% during the quarter. Secondly, the higher private investment. During the quarter, firms continued to expand their capacity, particularly through increased spending on machinery and equipment to cater to positive prospects. Growth in private investment activity advanced by 6.9% in contrast to 6.1% in the preceding quarter. Thirdly, the lingering commodities specific supply shocks. This led to a contraction in commodity production and exports. The Malaysian economy registered a sustained growth of 4.4% in the third quarter. On the demand side, growth was driven by the private sector amid a decline in net exports. In particular, private consumption grew robustly by 9%, supported by sustained wage growth and a 2-month tax holiday in July and August. And I should mention that details on the various demand and supply components are provided as additional information in the set that you have with you. On the sectoral front, growth was affected by lingering commodity-specific supply shocks. The adverse impact on overall growth was mitigated by expansions in the other economic sectors, which account for 82% of the economy. With the 4.4% growth registered in the third quarter, the Malaysian economy expanded by 4.7% in the first 3 quarters of the year. Growth in the second and third quarters in this year could have been higher by 50 to 70 basis points had it not been for the supply shocks in the mining and agriculture sector. Of significance, the remaining 82% of the economy grew by 6.2% in the first 3 quarters of the year. In view of these developments, Malaysia is on track to register a growth of 4.8% for 2018. Gross exports moderated to 5.2% on account of a slower expansion in non-E&E manufactured exports amid a smaller contraction in commodity exports. Domestic exports, which measures exports of locally produced goods, declined marginally to minus 0.2%. Gross imports moderated to 6.3%, following a deceleration in capital imports and lower imports for re-exports. Going forward, Malaysia's export growth will continue to be supported by the demand from its major trade partners, higher domestic production capacity in the E&E and primary related manufacturing sectors, and recovery of commodity output. The current account surplus of the balance of payments was sustained at 3.8 billion ringgit, or 1.1% of GNI. This was due mainly to a higher goods surplus amid a larger primary income deficit. The primary income deficit of 15 billion ringgit is the highest since the fourth quarter in 2014 on account of higher income by FDI companies in the mining and manufacturing sectors. Of note, 26.4% of the income was reinvested back in Malaysia. In the first 3 quarters of 2018, Malaysia's current account registered a cumulative surplus of 22.7 billion ringgit, or 2.2% of GNI. Moving forward, the current account is expected to remain in surplus, supported by a sizable goods surplus, which more than offset the deficits in the services and income accounts. For the full year, this year, the current account balance will be at 2 to 3% of GNI. Let me now move on to the monetary and financial developments during the quarter. Headline inflation declined to 0.5% in the third quarter, mainly due to the impact from the GST zeroization. The annual average headline inflation will be low in 2018, mainly reflecting the impact from the GST zeroization and the lower contribution from domestic fuel prices. Going forward, however, headline inflation is projected to increase, mainly due to the higher projected global oil prices and the floating of domestic fuel prices. While the impact of the consumption tax policy will contribute to higher headline inflation in 2019, it will lapse towards the end of 2019. Underlying inflation, which excludes the impact of the consumption tax policy changes, is expected to remain contained. Monetary policy remains accommodative and supportive of economic activity. Monetary operations continue to ensure sufficient liquidity to support the orderly functioning of money and foreign exchange markets and intermediation activity. The global environment is facing a multitude of challenges, emanating from risk to global growth, global liquidity shifts, and risk from further financial market volatility. Monetary policy needs to navigate this environment cautiously and will assess incoming data and the potential impact to both domestic growth and inflation. The NPC will also continue to monitor for signs of destabilizing risks of financial imbalances. Domestic financial stability was preserved in the third quarter of 2018. The financial system remained resilient, while domestic financial markets continued to function in an orderly manner as confidence in the financial system was sustained. The banking system and insurance industry remain well capitalized to meet unexpected shocks. As at end September 2018, excess capital buffers of financial institutions remain strong at 144.3 billion ringgit. Stress tests affirm financial institutions' resilience to severe macroeconomic and financial shocks, both at the system and institutional levels. Private sector activity remains supported by the higher financing growth in third quarter of 6.5%. In the capital market, corporate bond issuances continued to register double-digit growth, mainly reflecting large issuances in the financial and utilities sectors. Growth in total outstanding loan increased to 5.1% in the third quarter, driven by higher loan growth to both businesses and households. In line with regional currencies, the ringgit depreciated by 2.5% against the US dollar in the third quarter of this year. This was driven mainly by non-resident portfolio outflows amid the continued strengthening of the US dollar. The strength of the US dollar was supported by positive US economic data and outlook during the quarter. The ringgit and the regional currencies were also affected by negative sentiments due to concerns over contagion risks from vulnerable emerging market economies. In the same period, non-resident portfolio investment registered significantly more moderate outflows in the third quarter this year. Going forward, the ringgit will continue to be affected by the ongoing strength in the US dollar and external uncertainties. There was lower emerging market risk aversion towards the end of the third quarter, which led to improvements in sentiment within the domestic financial market. The onshore FX volume remained at a healthy daily average level, and the bid-ask spread for the US dollar ringgit narrowed in September to 20 pips compared to 28 pips in July, following lower market volatility. And the average intraday movement of the US dollar ringgit pair narrowed further to 67 pips ahead of the budget 2019 announcement in November. As at end September 2018, non-resident holdings of the Malaysian government bonds declined marginally from 23.7% to 23.2%. This is attributed to both domestic and external factors. Emerging market risks increased following concerns on Turkey and Argentina, escalation of the US-China trade war in mid-September, and the Fed rate hike expectations during the quarter, and the eventual Fed rate hike on 27 September. Long-term investors remain the major holders of government bonds. Central banks or government holdings stood at 35.4%, while pension funds holdings stood at 17.3%. Malaysia's external debt remains manageable and poses no immediate risk to the economy given its currency and maturity profiles. More than half of the external debt is skewed to medium to long-term tenure, limiting rollover risk. And about one-third of the external debt is denominated in ringgit and accounted by non-resident holdings of ringgit instruments. The remaining foreign currency denominated external debt does not pose a material risk. Interbank borrowings and non-resident deposits are subject to prudential liquidity management practices, while intercompany loans are on flexible or concessionary terms, and trade credits are backed by export earnings and are self-liquidating. These instruments account for 61% share of foreign currency external debt. We have a box article on Malaysia's external debt in the report, providing a comprehensive profile of our external debt and assets. As highlighted earlier, about one-third of external debt is ringgit denominated, which is not exposed to currency fluctuations. Reflecting the decentralization of reserves, domestic corporations and banks have accumulated significant external assets abroad, amounting to 3/4 of Malaysia's 1.7 trillion ringgit external asset as at end the third quarter of this year. Of note, Malaysia has a net foreign currency asset position which provides a buffer against exchange rate depreciation, and these assets can be drawn upon to meet borrowers' external debt obligations without creating a claim on Bank Negara Malaysia's international reserves. And the international reserves to short-term debt coverage at one time remains sufficient to facilitate international transactions. Malaysia's short-term external debt is mostly by banks. This arises because of the centralization of treasury operations of our banks operating in the region and the sizable presence of foreign banks in the domestic economy, which are funded by their parent banks. Banks' intragroup borrowings account for 36% of short-term external debt. As it stands, although bank short-term external debt amounted to 309.6 billion ringgit, the bank's foreign currency liquid assets comprising of cash and cash equivalents, interbank placements, and unencumbered debt securities stood at 151.7 billion ringgit. These liquid assets can be drawn upon to meet their short-term external debt obligations without creating a claim on Bank Negara Malaysia's reserve. Going forward, our economic prospects remain firm. Growth in 2018 will be driven by strong private sector expenditure amid the adverse commodity supply shocks as mentioned earlier. Going into 2019, private sector activity will remain the key driver of growth as rationalization in public sector spending continues. The coming on stream of new production facilities, for example RAPID, and recovery in commodity production are expected to further support growth. Private consumption will be supported by employment and income growth, while private investment will be supported by both foreign direct investment and domestic direct investment in diverse sectors. We recognize, however, that risks to growth remain tilted to the downside, stemming mainly from any escalation of global trade tensions, greater financial market volatility, and disruption in commodity production. Before we conclude this section, allow me to stress that the firm growth prospects of the Malaysian economy is supported by sound macroeconomic fundamentals. What do we mean by this? First, the economy is well diversified in terms of sources of growth as well as export products and markets. Second, labour market conditions remain favourable, underpinned by continued wage and unemployment growth. Malaysia remains an attractive destination for FDI. The current account continues to register a surplus, and Malaysia's deep financial markets and resilient banking system with strong financial buffers will ensure orderly and efficient financial intermediation in the face of financial market headwinds. Given these sound fundamentals, Malaysia is well positioned to adjust to the deeper structural reforms being undertaken by the government. The reforms will position the economy on a firmer footing and to perform better going forward. The quarterly bulletin publication also includes a box article on ongoing trade tensions. Allow me to provide some key highlights. The article is a follow-up from a box article on trade disputes that was published in the first quarterly bulletin. This article incorporates actions that have seen been implemented and proposed, and provides insights into the potential spillovers to Malaysia. At this point, trade tensions have escalated following recent announcements of more tariffs by the US. This could lead to lower global GDP and trade activity, posing a major shock to global growth prospects. For Malaysia, the current trade actions are estimated to weigh down GDP growth by 0.3 to 0.5 percentage points in 2019. Let me stress, this is already been incorporated in our growth forecast. We also consider a downside scenario of further trade actions which could reduce global growth significantly to 2.9%. This could lead to an additional reduction of 0.9 to 1.1 percentage points to Malaysia's growth. However, potential trade diversion opportunities could partially mitigate the negative impact of trade tensions. To ensure that we remain resilient in managing this risk, Malaysia must continue to take pragmatic stance on open trade policies by widening trade relationships and ensuring domestic policies are supportive of economic growth. I have come to the end of the presentation. We will be pleased to take questions now, and as usual, let us divide the Q&A session into 3 sessions. The first session to discuss any questions or any clarification that you may wish to have on the economy, followed by the financial sector, and the third section we will take other questions. My team and I and Datuk Sri Jose and his team will be pleased to provide any clarification.